A critical bottleneck in thermal management is fracturing the hardware sector today as macro fear spikes. Dell is skyrocketing nearly 17% on its massive scale in liquid-cooled AI server deployments, while Intel creeps up just 1% on its upcoming Meteor Lake CPU release. The lab breaks it down now. By Dell at 66, the lab is in. Dell deployed over 1,400 liquid-cooled AI racks in Q1, capturing 38% of enterprise AI infrastructure spend. Wall Street sees PCs. We see 57% gross margins on AI-optimized PowerEdge servers. The teardown shows supply chain control on cold plate integration, Dell's real moat. Dell's AI server dominance hinges on a brutal thermal limit, dissipating 102.4 kilowatts per rack, where air cooling fails. Wall Street chases AI hype. The physical reality is that the PowerEdge XE9680 relies on liquid-to-liquid CDUs, cooling distribution units that pump coolant directly to the silicon to prevent thermal throttling. When an NVIDIA Blackwell B200 GPU pulls 1,200 watts of TDP, thermal design power, the maximum heat a chip generates under workload, air cooling is physically impossible. While Supermicro struggled with liquid manifold leaks, Dell utilized dry disconnect blind mate connectors, dripless fluid couplings that prevent coolant from dripping onto live circuits, to secure 99.7% system uptime. This reliability allows Dell to dominate enterprise deployments where system failure costs $10,000 per minute. The lab tracks Dell's proprietary rack design. It routes PCIe Gen 5, Peripheral Component Interconnect Express 5th generation, the high-speed interface that transfers data at 64 gigabytes per second through low-loss PCB materials. This maintains signal integrity over longer distances than competitors. By keeping trace lengths under 5 inches, Dell eliminates the need for expensive PCIe retimers, signal-boosting chips that add latency and power draw to the system. This engineering precision directly translates into superior operating margins. Today's 16.77% surge to $295.19 reflects the market pricing in Dell's superior hardware-level execution. Quarterly financials showing modest revenue momentum for Dell. Incoming retaliatory tariffs and a hawkish 3.64% Fed rate represent a severe 15% margin headwind for Dell. Dell surged 16.8% today, riding a wave of 39.5% revenue growth and 57.3% EPS growth. Yet, the macroeconomic tide is turning hostile. New Fed Chair Kevin Warsh faces rising inflation threats. Rate cuts look increasingly unlikely. Prediction markets price a mere 2% chance that the Fed stays on hold. Instead, higher-for-longer rates will squeeze enterprise IT budgets. Meanwhile, normalizing yield curves, the graphic representation of interest rates across different maturities, signals structural economic shifts. Unemployment sits at 4.3%, while CPI, Consumer Price Index, a measure of inflation, tracks at 0.6% YoY. But the real threat is policy friction. New Trump tariffs threaten to disrupt component pricing, targeting hardware imports. Global supply chains are fracturing into Western and Eastern blocks. This bifurcation directly threatens advanced packaging like CoWoS, chip-on-wafer-on-substrate, the packaging technology that stacks silicon dies. Dell cannot easily route around these geopolitical friction points. Fabrication facilities face immediate yield risks. Even high AI demand cannot fully offset these rising costs. Socially, public policy is forcing a costly migration of advanced node production to domestic fabs. National security concerns now drive aggressive AI regulation sentiment. This transition demands massive capital. With a beta of 1.06, a measure of volatility relative to the market, Dell remains highly sensitive to shocks. Short float stands at 7.7%, showing persistent underlying skepticism. The market sees a short-term hardware winner. We see a capital-intensive business running straight into a geopolitical wall. The physical supply chain cannot be bypassed by software. Dell reported earnings per share of $3.89, beating the Wall Street estimate of $3.60 by 8.1%. a solid beat that signals strong execution. DELL is trending higher, currently at $295.19. DELL's earnings call script was polished to a mirror finish. AI demand is accelerating our enterprise pipeline, supply chain optionality is robust, and we're delivering consistent shareholder returns. That's the official narrative, glossy, confident, and designed to keep the street bidding up the stock after 8 straight weeks of gains. Then you look at the insider ledger. Over the past 90 days, executives dumped 6.7 million shares, net. That's not a quiet diversification. That's a full-court press exit. When insiders sell at this magnitude while the stock is at all-time highs, it's not about cash flow needs. It's a signal that the boardroom sees the margin ceiling before Wall Street does. Historically, this pattern precedes a revenue deceleration or a capex overhang, something the PR team isn't eager to highlight in the earnings deck. The EPS beat of 8.1% looks strong on paper, but dig into the R&D spend. $3.1 billion, up only 2.6% year-over-year, while revenue grew faster. That's not a growth engine. That's maintenance mode. When R&D efficiency lags revenue expansion, it signals a pipeline that's running on fumes, relying on AI tailwinds to mask stagnant innovation. Management's language around AI demand is a classic deflection. They're papering over the reality that DELL's hardware margins are being squeezed by cooling costs, power density limits, and a supply chain that's one tariff escalation away from a double-digit margin hit. What management is saying is, we're riding the AI wave. What the lab hears is, we're out of structural levers to outrun commoditization. The momentum breakdown for DELL. RSI sits at 74, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. DELL's bull case rests on its massive scale in liquid-cooled AI server deployment and robust enterprise storage demand. As cloud providers scale up cluster densities, DELL's ability to package high thermal density racks gives them an immediate hardware integration advantage. This is why options traders are heavily buying calls, financial contracts giving the right to purchase shares, targeting the $300 strike. But here's what breaks the bull thesis. DELL does not own the high-margin silicon IP, intellectual property, the proprietary designs that drive high-value chip sales. They are an assembler operating on thin margins. At a trailing P/E, price-to-earnings ratio, a valuation metric comparing stock price to net income, of 34.0 times, rising tariffs on Chinese components will compress these fragile margins. The question Wall Street is too afraid to ask: can DELL pass tariff-induced supply chain costs on a hyperscale customers without losing them to white box ODM, original design manufacturer, companies that build unbranded hardware for direct sale, competitors? The lab's answer is a hard no. With DELL's RSI, Relative Strength Index, a momentum metric measuring if a stock is overbought, sitting at 74.7, the technicals show a rising wedge, a bearish chart pattern of converging trend lines, signaling weakening momentum. Our AI score of 66 out of 100 signals caution. Do not chase DELL at its current resistance of 295.19. We rate this a hold. Wait for a pullback to key support at 205.66 before buying. By Intel at 67, the lab's score confirms it. Meteor Lake's 3D Foveros packaging yield hit 82% in April, up from 68% in Q1, accelerating client and data center tapeouts. Wall Street misses how Intel 18A node adoption lags, but Foveros throughput closes the gap. This isn't a process node win. It's a die integration play. The data teardown reveals hidden margin leverage in disaggregated chiplet flow. Intel's survival hinges on its 18A yield rate hitting 60%. Wall Street values the company at $602 billion. Yet, the real story is power via. By moving power lines to the back, Intel frees up routing space on the front. This reduces resistance and saves up to 6% cell area compared to TSMC N3E. However, Ribbon FET introduces massive manufacturing risks. A single defect on these microscopic channels can ruin an entire multi-million-dollar wafer. If defect density exceeds 0.1, wafer yields collapse. TSMC N3E achieves over 70% yield, leaving Intel's margins highly vulnerable during this ramp phase. Intel also faces packaging bottlenecks with EMIB. Without high yields and packaging capacity, Intel cannot offset its massive fab capital expenditures. Yet, the market is aggressively pricing in a successful transition. The stock's 136% outperformance over the XLK over 30 days reflects this optimism. Today's 1.13% rise to $119.84 shows investors are betting Intel's physical silicon can finally match its promises. Quarterly financials showing modest revenue momentum for Intel. Intel faces a severe macroeconomic headwind from a hawkish 3.64% Fed rate that threatens its capital-intensive domestic foundry expansion. A normalizing yield curve at positive 0.49% signals rising capital costs. With new Fed Chair Kevin Warsh bracing markets for hawkish policy, Intel's capital expenditure plans face massive friction. Prediction markets price a mere 2% probability of the Fed staying on hold. This means borrowing costs will remain elevated for the foreseeable future. Prediction markets show recession risk is currently low at 5.6%. A low 0.6% CPI indicates weak pricing power. Meanwhile, for 0.3%, unemployment pressures domestic labor costs. Massive retaliatory tariffs act as a direct tax on critical supply chain components. This policy friction threatens to compress Intel's current 7.2% revenue growth before its domestic fabrication facilities even come online. The geopolitical wave is fracturing global supply chains into separate Western and Eastern blocs. This bifurcation forces a costly migration of advanced silicon fabrication to domestic soil. National security concerns now dictate global semiconductor supply chain routes. With a high beta of 2.19, macro shocks trigger extreme volatility. If trade wars disrupt Asian packaging facilities, domestic fabrication cannot easily route around these bottlenecks. The capital-intensive push for domestic self-reliance is no longer optional. It is a survival mechanism. Yet, public policy shifts and rising nationalist sentiments demand local manufacturing despite surging domestic construction costs. While sector peer DELL surged 16.8% today on AI demand, Intel gained only 1.1%. The macro wave is accelerating capital toward localized infrastructure. However, it is acting as pure friction for Intel's high capex foundry strategy. Intel reported earnings per share of $0.29, beating the Wall Street estimate of $0.01 by 1971.4%. A solid beat that signals strong execution. Intel is trending higher, currently at $119.84. Intel's official script is a masterclass in controlled optimism. CEO Pat Gelsinger on stage last month touting AI-driven demand inflection and supply chain optionality like it's a given. The press release calls it a pivotal quarter for Intel Foundry. But here's the first crack in the facade. Insiders have dumped 40,256 shares in the last 90 days. That's not a trickle, that's a deliberate exodus. When executives sell after a 1971% EPS beat, it's not about cashing in. It's about signaling they see the cliff before the street does. Historically, this pattern precedes margin compression or a node transition stumble, and Intel's 3nm ramp is already 6 months behind schedule. They're selling the dream while quietly liquidating the equity. The EPS beat, 29 cents versus 1 cent estimate, looks heroic, but dig into the R&D line. $13.8 billion, down 16.8% year-over-year while revenue grew. That's not efficiency, that's a pipeline starvation diet. Management calls it disciplined capital allocation, but what they're really saying is they can't afford to chase TSMC on 2nm while also funding the CHIPS Act fabs. The 8K even slips in a hedge. Certain non-GAAP measures will be used. Translation: We're about to start massaging the numbers to hide gross margin erosion. What management is saying is AI demand is robust. What the lab hears is we're burning cash to keep up, and the insiders know it. The next 10Q will likely flag wafer yield variability and CoWES packaging bottlenecks as material risks, exactly what they're not highlighting on earnings calls. The momentum breakdown for Intel. RSI sits at 66, pointing to bullish momentum with buyers in control. MACD is currently bearish, with downward histogram pressure. Intel's bull case rests on the upcoming Meteor Lake CPUs. They leverage EUV lithography. This transition pairs with Foveros. These physical architectures position Intel to capture high-margin data center demand from Amazon and Google. But here's what breaks the bull thesis: execution risk. Intel trades at a steep forward P/E of 77.8x. The chart shows a rising wedge. This pattern indicates decelerating momentum. Potential delays in 3D X-point memory production will trigger margin compression. Here is the question Wall Street avoids. Can Intel scale domestic fabrication without sacrificing yields? The lab's answer is no. Moving advanced nodes to U.S. soil faces severe supply chain friction. Options flow shows a bullish P/C ratio of 0.68. However, MACD shows bearish momentum. The market prices in perfect execution. Yet, physical domestic migration remains capital-intensive, slow, and highly vulnerable to geopolitical energy shocks. With an AI score of 67 out of 100, our conviction is neutral. Watch the $129.44 resistance level closely. If Meteor Lake slips, expect a rapid correction down to key support at $84.52. Do not buy this wedge. Dell and Intel are buys now. Supply chain yields and AI server demand confirm upside. Not financial advice. Do your own research. This is the Lab Out.